Hi, I'm Darcy Crow, Senior Investment Advisor and Portfolio Manager at Crow Private Wealth. Thank you for joining us today for our Alternative Spotlight series. If you haven't had the opportunity to view our past videos, our Spotlight series focuses on providing exclusive access to best-in-class managers throughout Canada in various alternative assets. The most recent one that we actually posted was with Eamon McConnell from Kensington Private Equity. So if you missed that, I very highly recommend you have a listen. Alternative investments have been an important component of our client portfolios for many years, and the demand for these alternative assets has really heightened recently given our current market environment. And one area in particular that's causing investors, great concern at the moment is what do they do with their traditional fixed income allocation that remains, very important to investors. But of course, we're at this point in the market when we're at very low interest rates and we have the prospect of rising rates in the years ahead. So this presents a very challenging environment for your traditional fixed income, which has played an important part in portfolio and particularly for those in the retirement years. So with that, we're very pleased to have Richard Usher-Jones joining us today. Richard joined Canso Investment Counsel in 2009 as a member of the investment team, where he is a portfolio manager and responsible for credit analysis. And he also serves as president of Lysander Funds. So Richard, thank you so much for joining us today. I know Canso has the breadth and depth of experience to really deliver fixed income solutions that can both protect and perform in this type of market. So we really appreciate you being here to discuss, the challenges and opportunities that you see today.
Well, Darcy, delighted to be here. Thanks very much for the invitation.
Yeah, fantastic. So if we can start off, just for those that may not be familiar with Canso Investment Counsel, if you could just maybe give us a brief overview of the firm itself.
Sure, happy to. So Canso is not really a household name. We were founded in 1997 and actually named after the Canso airplane, which you can see in the photo there. And John Carswell, our founder and president, still very actively involved in the business today, was a graduate of Royal Military College, and he was an Air Force navigator. And his father was also a pilot, flew in the Second World War, and after service, he flew the Canso airplane, which you can see in the photo there. And it was not the fastest plane, and certainly not the maybe not the sexiest airplane, but it had a reputation of just getting the job done and being very dependable. And that's the image that we have at the organization. And our view is if we can deliver on that dependability for our investors, then hopefully we'll have some satisfied clients. But if you look today, we run a little bit over 33 billion in total assets, and that's pretty much entirely in credit and corporate bonds. So our specialty and our focus is in really lending money to companies and businesses, and we do that through buying their bonds in the markets or through new issues. We're a private company, though, and we think that independence and being private is a real key ingredient to our success. And today we're 55 employees, a couple above that actually with the summer students we have on board. But with 27 people on the investment team that are focused on that bottom-up independent research. And we think it's that breadth and depth of that research team that has really been key to the results that we've been able to deliver in the confusion that's existed out there in the pandemic recently.
Mm-hmm. Yeah, absolutely. And, I think, why don't we just dive in maybe and talk a little bit about the current market environment. So it'd be really great to get, your insights into what you see as the greatest risks out there today in fixed income, and maybe how you're positioning, portfolios to really protect and, what could be, a challenging market in the years ahead for traditional fixed income.
Sure. It's interesting because it's sort of a human thing that we're always most prepared for the risks that we most recently addressed. And last year it was one of liquidity and I'd say and credit risk. And we've come through a pretty volatile period. But our concern is that the risks forward are likely going to be pretty different than what we just came through. Number of bullet points on the slides here, and this is something I think we're all familiar with, is that overall bond yields are incredibly low. We've come off the bottoms. At the beginning of this year, I think a 10-year government of Canada bond was yielding less than 0.7%. Today, it's double that at about 1.45 or so. So yields have lifted off the bottom, but they're still very low. We've seen a rapid recovery in credit spreads, and a credit spread is the additional yield that you get by lending to a corporation over and above a risk-free asset like a government bond. And as things have become more stable and it's more evident that we're going to climb out of this pandemic and the economy is going to reopen again, the risks have dissipated and those spreads have also narrowed. So the yields themselves that you used to get a year ago by lending to a corporation are quite a bit lower as well, although still above those that exist within government bonds. And there are still some pockets of opportunity in some of the businesses that are still most impacted by the pandemic. But I'd say our concerns are that the amount of stimulus and money that's gone into the economy and into the market is sitting there, but it's in people's savings accounts and their bank accounts. It hasn't yet gone into the economy. And when the economy reopens and we're allowed to, well, in Ontario, today's a pretty important day for a lot of people because you're allowed to actually go and sit with 3 other people on a patio, which we haven't been able to do for a couple of months.
It's been a long time coming, yeah.
I got to tell you, anecdotally, I've got friends that are saying, I don't care if I have to pay $100 for a beer. If someone's going to serve me with my friends on a patio, I'm going to go and do it. So as our economy reopens, that money is going to start to circulate again. That money is in the economy, but we haven't been able to spend it and it hasn't been circulating. Our concern is that when that money begins to circulate in the economy again, that is very likely going to drive inflation. Some of it might be temporary, but we think it's going to be longer lasting than many of us think. And that inflationary pressure could very likely have the effect to increase bond yields. And as you're quite familiar as an investment advisor and a portfolio manager, that on your typical bond that's a fixed rate bond, rising interest rates is quite negative as that resets the prices downwards on existing bond markets. And we think that investors need to be very aware of that and need to understand that traditional safe fixed income, which may have been Government of Canada bonds that today's low yielding, can be quite negatively impacted by the effect of rising interest rates. But fortunately, there's a number of things that you're able to do in a portfolio to, first off, be protective from that situation, and also to capitalize on some of the opportunities that are going to be presenting themselves in the market.
Yeah, no, absolutely. I think, the start of 2021, as you said, the yield take up that we've seen, and people were quite surprised to see some of the, these very large bond funds in Canada down 5, 6, 7% and not typically what you'll see in fixed income. And I think that's a really important part is, how it's performed in portfolios over the last 10, 20, 30 years. You have to look that we're in a very different environment, different challenges today. So, what I really like about Canso is that you do have that, diversified lineup of product that will work in different types of markets and market environments. And, we really focus on clients always sort of say, well, let's look at the historical performance, which we're going to look at right now. But it's also, we always want to say what's most important is what do we think is going to perform, going forward from the market environment we're in today, not necessarily how things performed in the past, because that might be very different. But, 2 of the products that you have that we use very frequently with clients is, the Lysander-Canso corporate value, as well as the Canso credit opportunities. So would love if you could give us a little bit of an overview of how those strategies work, how they performed, and maybe the opportunity that you see there today.
Sure. So good timing. So the slides there that just sort of list performance on the strategies you mentioned, but also what's been going on in the market. If you look at the far right-hand side, and this is going to the end of May, if you look at the corporate bond index, and because we invest in corporate bonds, we use that as a good indicator for how that overall part of the market is doing. But you can see it's negative 3.1%. And this is people's safe money. They buy bonds to have safety. If you look at the universe index, which also includes government bonds, that's actually even more negative at about -5%. But if you look at the corporate value strategy, which is our open-ended fund where it's long, so we buy underlying bonds. The performance is a little bit over 7%, 7.4%. versus the Credit Opportunities Fund, which is about 6.5%, 6.4%. So quite a different picture compared to what's gone on in the overall market index, which are quite negative at -3 and -5%. How we research and how we look at things is we're very much bottom up and focused on really understanding the fact that we're lending money to businesses that are using that money to operate their business. So when you buy a bond, it comes with a coupon, a yield associated with it, and contractually, it's our right to receive that yield. And as a credit investor, we do research on the underlying business and really assess the ability to service the debt and to continue to pay us those rates of interest. And we know we run people safe money, and we also know that our upside is sort of governed by contractually what that rate of interest is. So we spend a lot of time trying to look at all the things that could possibly go wrong, that could interrupt that company or that business's ability to service their interest payments. And so that's where we spend a lot of our time. And also, if things do go wrong and there's an interruption, as there have been extensively in the pandemic, to business operations that could cause issues with them servicing the debt, we spend a lot of time knowing what our rights are if there is a default and if there is an inability for that issuer to continue to pay the rates of interest. And that's where we want to make sure that in the event that things don't work out as planned, that we know what our rights are so we can work to recover the monies that we've lent. But that's certainly, we run a diversified portfolio, and how you mitigate risk is by doing that deep research and developing that understanding, and also knowing what your rights are.
Yeah, absolutely. So do you mind just going into a little bit more detail in how the corporate value is positioned and what you would hold within corporate value versus what you would hold within the credit opportunities portfolio? And I guess, what they hold today, how they're positioned, and what you think the opportunity would be in both of them from where we're at in the market today?
Sure. So this is a great slide to just illustrate the high level characteristics of the two strategies. And I'll talk about the fund on the right hand side first, LYZ 801, and both funds to identify are in those orange boxes. So how's the fund positioned? So the yield to maturity, which is if we didn't trade the bonds in the fund and we continue to hold them and mature them in the portfolio, we'd collect a yield of about 3.1%. You can see the duration, which is the level of sensitivity to how impacted the portfolio would be with changes in interest rates. And we're most concerned about a continued path of rising interest rates with a duration of about 2.8 years. That is very low in comparison to the index. And we don't have the index numbers on here, I don't think, but the corporate index is just shy of about 7 years, and the universe index is closer to about 8 years duration, which is a lot of sensitivity. That if there's a 1% move up in yields, the overall market with a duration of 8 is going to be down about 8%. So you can see the impact with the indication of about 2.8 years is far less on the corporate value bond fund. And I'd also say that duration figure of 2.8 years is somewhat overstated as well in terms of the sensitivity, because many of the bonds that we own within the portfolio, the prices are more going to move based on what's happening with the underlying businesses rather than what's happening with interest rates in general. But if you look at those numbers in contrast in the Credit Opportunities Fund, you get an uptick in yield of about 3.5% compared to just over 3%. But also additionally, duration is about a year shorter at 1.8 years. And what we really like at Canso about the Credit Opportunities Fund is we have the ability to incorporate an interest rate hedge in the portfolio where we can buy corporate bonds, but we can reduce the duration where we actually match it with a Government of Canada bond of the same duration and we short that. And that allows us to really not eliminate, but significantly reduce the effect on the portfolio of rising interest rates. And that's why I think that Credit Opportunities Fund is a great strategy for the environment that's facing us today, where We do well when the market's confusing because we've got the research capabilities that can uncover the uncertainty and understand all the investment opportunities, and the ability to do that in credit opportunities and also incorporate the protection against a rising interest rate environment, we think is a really beneficial tool to have.
Yeah, absolutely. And I think that's why, you know, when you take into account where we're at in the market, owning strategies that have those additional tools and flexibility that, you know, some long only portfolios may not have is a, you know, really critical tool in this type of environment. So so that's great. And I guess, you know, to close things out, you know, we have a lot of conversations these days, you know, the old 60-40 portfolio and you know, where does fixed income belong in the portfolio today, and are these alternatives or are these still fixed income? So with just, you know, from where you sit as a portfolio manager in this space, you know, where do you see fixed income? Is it still critical to portfolios in terms of diversification, and you know, do you still see it playing a key role in portfolios? And so I guess specifically how Canso funds you think can really benefit and continue to play an important part within portfolios given where we are today?
That seems to be a pretty popular question or concern these days, that many investors are concerned about what's happened in the average bond fund, which are the average bond fund by definition is the universe, and it's negative this year. And you know, people, you don't like a negative experience. You have to remember why you own fixed income within a portfolio. It's the ballast, it's the buffer to the equity components and to the other strategies within the portfolio. And that played out in a very true form entering the pandemic, where equity markets were, values of equity portfolios were cut in half, and bonds provided a significant amount of stability in that. And I would say that you still need that within your portfolio, and you need to have that fixed income and that bond allocation. If you're in retirement, it should be the fixed income you're dipping into and you're using for your spending needs, and as well for just general diversification. But I think going forward, you really need to be cautious and have a really good understanding of how you're accessing that fixed income. And you know, at Canso, we run fixed income portfolios. We know that we're entrusted with a lot of people's safe money, and we want to make sure that we take that very seriously. We want to make sure that we're protecting against the risks out there, and we think the risks are always credit. And with our investment team, we're doing the research to make sure that as much as possible we can avoid the more problematic businesses and companies. But going forward, we are very concerned about the impacts of a continued rising rate environment. And there's a number of things that we're employing, we employ within the strategies to be protected from that. And that's having shorter duration. We can buy floating rate instruments and securities whose rates of interest change as interest rates change, rather than having the price of the bond reflect that. And you know, I would really say, don't give up on fixed income, because equity markets continue to be volatile, and they've been, you know, having equity exposure has been very beneficial in the last year. But as you can remember, going through the pandemic, there is that volatility, and you're going to need some stability in your portfolio. And it may not be in the traditional bond fund. So you should look at some of the other strategies like the credit opportunities or corporate value.
Yeah, no, and I think we'd be in complete agreement with you there, and it's an ongoing dialogue, and it's where, you know, over the years alternatives have played more and more of a, you know, an important part in client portfolios. We've been using them for over a decade now, but it's the same conversation. You don't want to be tilting equities too high right now. They're trading at heightened valuations as well, and you don't want to get outside of, you know, clients' risk appetite. So I think you make a very good point. Fixed income will still be a very important part of the portfolio, but rather than just being a more passive part where it might say, okay, you can just own those traditionals or own the bond fund or own, you know, an ETF. You really have to be putting the work in and having, you know, managers in place that have those tools and the knowledge and experience to deliver in what is now a much more challenging environment. So we really appreciate you, Richard, taking the time to sort of walk through, you know, an overview of Canso, your experience there, I guess that, you know, the tools that you have in place to address the challenges that we see today. today. And they've certainly, looking at this year, if this is the type of market environment that we're in, have delivered very, very well to clients in comparison to what the broader, fixed income indices are doing. So thank you for that. Thank you for taking the time to have that discussion with us today. And I just do need to reiterate, these discussions shouldn't be considered a direct recommendation, but if you are interested in learning about Canso or speaking with us directly about any fixed income strategies, our team would be very happy to set up a time to do so. So thank you, Richard. Thank you, everyone, for watching with us today, and we look forward to keeping you up to date on all the alternative strategies in the months ahead as well. So have a wonderful day, and thanks, Richard, for being here today.
Thank you, Darcy. Thank you.
Okay, take care.